Dollar cost averaging, or DCA, is not only one of the easiest ways to invest, but can also be one of the most rewarding. Investors have been using DCA strategies for generations, but it's safe to say that the gains your grandparents made DCAing into traditional investments are nothing compared to what you could potentially gain by DCAing into crypto. That's why today we're going to tell you everything you need to know about the DCA investing strategy and how you can use it to create a life-changing crypto portfolio. Stay tuned, folks. This is a video you literally can't afford to miss. Okay, before we go any further, you need to know that I'm not a financial advisor and nothing in this video should be considered financial or investment advice. This video is purely for entertainment and educational purposes only. It's also important to note that most of this video is based on a recent survey from Kraken's Learn team, which asked crypto investors about their DCA strategies. We'll leave a link to that survey in the description, and we'll come back to it a little later on. For now, though, let's first give a bit of context. So, if you're not familiar with DCAing, here's everything you need to know. DCA stands for dollar cost averaging and is probably one of the most stress-free ways to invest in this crazy market of ours. Essentially, it's where you invest a regular amount into a cryptocurrency at a regular interval, regardless of the price of that asset at the time. Now, there's no hard and fast rule on how often these investments occur, so it's completely up to you and your own preferences. So, as an example, you may choose to invest $100 into BTC on the first day of every month. Alternatively, you could invest $10 every single day, or maybe you'd prefer to invest $1,000 every 2 weeks. The choices here are endless, but the key takeaway is that you are consistently investing some amount on a regular basis and not giving it too much thought. A popular saying is, set it and forget it. Now, the reason investors DCA is because, on average, you can make about the same amount of gains as you would if you were actively trading crypto. Unless you've got all the time in the world to keep an eye on the charts, and make no mistake, trading is a full-time job, and you have the skills to take on asset managers, pro traders, and bots, then a simple DCA strategy could be a relatively stress-free way of getting a similar result. And at the end of the day, that's what counts. But there are other benefits too. For example, DCAing can help you stay disciplined in your investment approach, particularly if it's automated. Most centralized exchanges have tools to help you set up regular investments and give you the flexibility to choose the amount and the frequency of those investments. And because a DCA strategy helps you to minimize your exposure to volatility, it can even help reduce your average cost of investment. Of course, this really depends, though, on where those investment intervals fall relative to the asset's price at the time. But given how volatile the crypto market is, it's highly unlikely that you'll be able to time the market right every single time yourself. And by the way, if you're enjoying the video so far, obliterate that like button to give it a boost, decimate that subscribe button, and give that notification bell just a gentle nudge to catch our next one.
Are you ready for deals? Are you ready for trading fee discounts? Are you ready to save some money? If the answer is yes, then you're ready for the Coin Bureau Deals page. Yes, Coin Bureau brings you the very best deals and promotions in all of crypto. You won't find offers like these anywhere else. Discounts on the best hardware wallets! Exchange sign-up bonuses of up to $100,000! Trading fee discounts of up to 70%! Coin Bureau's brand new altcoin-focused subscription service! The Coin Bureau Deals page is even better for you than this piece of succulent, protein-rich, nutritious grilled chicken! Head on over to coinbureau.com/deals or click the link in the description below. Don't delay. Check out the Coin Bureau Deals page today. These deals are so hot, I need to cool down. Yeah!
So, with that context in mind, let's turn back to that Kraken survey. It discovered that today, 59% of crypto investors invest using a DCA strategy, while just 30% will try to time the market. What's quite staggering is that the survey also reveals that out of the 1,100 people questioned, a whopping 83% said they had used a DCA strategy at some point. This underscores just how simple and effective such a strategy can be. Recall that besides being the easiest way to invest into crypto, the key benefit of DCAing is that it allows you to reduce your exposure to volatility. In fact, 46% of the survey's respondents have this as the main reason for them using a DCA strategy, almost double the second highest response of encouraging consistent investment habits. Obviously, this makes perfect sense. Crypto is a very volatile market after all, so crypto investors will be looking for a way to reduce those risks. And what better way to avoid the impact of those massive red and green candles than by just ignoring them completely? Anyway, jokes aside, just 12% of respondents say they use DCA to remove emotion from trading decisions, and honestly, we're a little surprised this wasn't higher. That's simply because the stakes can be very high in crypto. Trying to time the perfect bottom to ape in, praying the price goes up by 10x or 100x, and then timing the perfect top to sell can be an emotional rollercoaster, especially with the constant threat in the back of your mind that it could all go to zero in a heartbeat. But then again, I suppose that really depends on which cryptos you're aping into. Anyway, 8% of respondents say that DCAing makes investing easier for beginners, which makes much more sense for two reasons. First, it's only really beginners that would have given that answer, which cuts the audience rate down significantly. Second, it's obviously true. DCAing really can make investing into crypto accessible for everyone, even someone who's never bought a single crypto before. And finally, 6% said that they use a DCA strategy because it lowers the average investment cost over time, as we discussed. Now, the next part of Kraken's survey report suggests that investors on a lower income are more likely to react emotionally when it comes to crypto trading. After all, crypto is seen by many as a way to get ungodly gains that can't be found anywhere else. However, the risks that an investment could go down just as fast as it goes up can create a lot of mental pressure, which is well known to cause investors to act irrationally, leaving them wrecked in the process. In any case, Kraken's Learn team gives us a breakdown of investors with an income under $100,000. According to the survey, the amount of investors using a DCA strategy depends on their income, although there does seem to be a level of consistency. But what's bizarre is that this section of the survey report doesn't give us a clear view of the bigger picture. For instance, we learn that 57% of investors earning under $10,000 will use a DCA strategy, whereas 26% will try to time the market. But what about the rest? Do these guys use a different strategy? Well, maybe they've stopped investing into crypto altogether. Heck, what if they never did? Anyway, oddities aside, the remaining brackets are as follows. 30% of investors earning between $10,000 and $25,000 use a DCA strategy, while 50% will time the market, which suggests that more investors in this bracket would rather take a risk-on approach, although it's worth noting that this seems to be the anomaly across these responses. Meanwhile, around 50% of crypto investors with an income between $25,000 and $50,000 will use DCA, while 31% will time the market, essentially a flip of the previous response. Interestingly, the exact same amount of investors earning between $50,000 and $75,000 would use either a DCA strategy or would try and time the market at 43% apiece. And 55% of investors earning between $75,000 and $100,000 will use DCA, while 31% prefer to time the market. As for crypto investors with an income of more than $150,000, the scales are tipped much more in favor of DCA. 66% of people earning between $150,000 and $175,000, whereas just 14% try to time the market. As for those with an income between $175,000 and $200,000, 75% will DCA and 20% will time the market. And 77% of crypto investors fortunate enough to have an income over $200,000 will DCA, while just 17% will time the market. Now, this is a perfect reflection of the volatility benefits of using a DCA strategy. Obviously, volatility presents risk, and for those with deeper pockets, a drop of a few percentage points can mean a loss of thousands, if not tens of thousands of dollars in fiat terms. Remember, it's not about how much you make, it's about how much you keep. Next, the survey report highlights that this balance is reflected outside of crypto too, and it also points out that younger investors are more likely to try and time the market with crypto than with other markets, although it doesn't offer any data points for the latter. This is a shame, to be honest. We would have loved to have seen how different demographics react to DCAing. Now, the survey then asked how investors rank their ability to stick to a trading plan throughout volatile periods. It seems that the higher the income an investor has, the more confident they are of staying on course. More specifically, 62% of people with an income of over $100,000 say they have a very strong ability to stick to the plan, whereas just 30% of people under $100,000 have the same outlook. This makes sense, and it all comes down to one word: comfort. An investor on a higher income is naturally going to be much more comfortable watching an investment go down than someone on a lower income who may feel pressured into making additional unplanned trades. We've all got bills to pay after all. What's intriguing is that the report then provides an infographic that shows how investors will typically respond when faced with losses. But the first thing it points out is that most crypto investors typically stick to their guns during a dip. You've got to respect that. Anyway, 61% of DCA investors will actually double down on their investments. Meanwhile, 27% of investors trying to time the market will simply stop trading, and 31% of lump sum investors will carry on lump summing. Now, the survey then asked investors how they typically respond to losses, and although the report doesn't seem to go into much detail here, the infographic provided reveals a clear trend. Put simply, the deeper an investor's pockets are, the more likely they are to double down on their investments when facing a loss. In other words, the richer folk know to buy the dip. Meanwhile, the less fortunate among us are more likely to either make changes to their trading strategy or stop trading altogether. Anyway, the report goes on to reveal that 73% of crypto investors keep an eye on market conditions more closely than traditional investors, and we reckon this is the most relatable statement yet. I mean, come on, be honest, how many of you find yourself checking your portfolio several times a day? Just know it's important to step away and touch grass sometimes. Now, notably, 66% of people over the age of 45 will watch the markets more closely, which is double the 33% of people aged 18 to 29. I suppose they're out there being young, having fun, and living their lives. And finally, the report also reveals that high earners will pay more attention to the crypto market than other asset classes, and that's most likely because the potential gains in crypto simply can't be found anywhere else. So then, that brings us to the end of Kraken's survey report. As you can see, DCAing can be a powerful tool for crypto investors and is, therefore, very popular. But by now, you've probably asked yourself why you don't just ape in with a lump sum at the bottom and ride it all the way to the top. Well, as we mentioned earlier, this is much, much easier said than done, and the risk you take on can sometimes outweigh the rewards, depending on the crypto in question. As we also mentioned earlier, a DCA strategy can give you a pretty similar outcome on average without the need to panic every time the chart sees a big red candle. Now, to illustrate why this is, let's go over a few hypothetical examples to show you just how game-changing a DCA strategy could be for your own portfolio. For this, we'll be using a DCA simulator, which is a free tool from Into the Cryptoverse. Shout out to our good friend Benjamin Cowan and his incredible website. Anyways, we'll use the 1st of January 2020 as a start date, and we'll use the same start date for each crypto to keep things fair. I should also point out that these cryptos have been selected for illustrative purposes only, so do keep that in mind. Now let's start with everybody's favorite crypto asset, BTC. If you'd invested just $10 a day from the 1st of January 2020 to the 1st of January 2024, you would have invested an impressive $14,620. by the 1st of January 2024, that investment would have been worth $31,670, well over double your initial outlay. That is not bad by any means, but I think you'd agree that we can do better. So let's take a look at another crypto, shall we? Why don't we look at Tron's TRX? So, using the same $10 a day approach, we already know that you would have invested $14,620. If you'd put that investment exclusively in TRX, then by the 1st of January this year, that TRX would have been worth $38,231, over $6,000 more than if you'd stuck to BTC. But again, I think we can do better. So, how about Binance's BNB coin? Well, if you'd invested just $10 a day between the start of 2020 and the start of this year, your $14,620 investment would be worth an impressive $72,315, almost 5x your initial investment. But what if you were feeling a little more degenerate and wanted to DCA into meme coins? Well, it goes without saying that this is basically gambling, and the success of different meme coins will be incredibly varied, to say the least. That said, we can probably use Dogecoin as a proxy here, seeing as it's the biggest meme coin out there by market cap. So, using the same $10 a day approach would mean that your $14,620 investment would be worth a jaw-dropping $142,488. In other words, a 10x return. Now, 10x is fantastic, but could we have done even better? Well, what if we checked the price of the crypto that seems to have dominated this market cycle? That's right, Solana. If you'd invested $10 a day into Sol from the 1st of January 2020 to the 1st of January 2024, your $14,620 investment would be worth, drumroll please, $300,661. That's a 20x on your investment and would have given you a profit of over 285,000 big ones. Now, obviously, this means that the amount you can get back on your investment depends on the cryptos you actually invest in. And it goes without saying that using the same investment strategy for other cryptos could have actually resulted in a loss, not naming any names, of course. But as you can see from these examples, a DCA strategy has the potential to be insanely profitable. Heck, if we refer back to BTC, it's worth remembering that even a 2x is a damn good result. Where else can you double your money in 4 years? Not many places, I would reckon. But if you'd rather take a more hands-on approach, then there are a few variants of the traditional DCA strategy that give you a few extra options at your disposal. For instance, there's dynamic DCA, also known as value averaging, where you adapt the amount you invest in each interval depending on market conditions. So, for example, you might invest $1,000 a month during a bear market, but slow that down to maybe $100 in a bull market. There's also a micro DCA strategy, which is actually the type we used in our earlier example. Essentially, this is just investing a small amount on a very regular basis, like the $10 a day approach we used. Typically, a standard DCA approach would involve a higher investment amount on a less frequent basis, for example, $500 a month. The important thing to remember is that there's no right or wrong answer here, though. DCA gives you the benefit of investing based on your own budget and risk tolerances, so you can really be as flexible as you want to be. All you need is the discipline to steer the course. The best part is you can set it and forget it, meaning you can completely avoid the charts. That way you won't make additional trades that could affect the end result. And with a stressful environment like the crypto market, it's hard to think of a better way to invest. Of course, though, DCAing isn't for everyone. And thankfully, we also have a guide on how to build your own trading strategy, and we highly recommend you check that out. After all, you could always combine your trading strategies with a DCA approach if you really wanted to go all in. Now, there's no denying that investing a lump sum can give you a higher return, and trading can be a great way to boost your gains. If done correctly, that is. Thankfully, we also have several videos on how to trade using technical analysis, and we'll leave a link to those in the description too. And if you'd rather keep up with the traders on a more real-time basis, then good news. We recently revived the Coin Bureau trading channel, which is now being led by Dan, our very own head of research. Trust us when we say that when it comes to crypto, there is nothing Dan doesn't know, except NFTs, apparently. So you can find a link to the Coin Bureau trading channel in the description, so why not head over and be sure to hit that subscribe button while you're there. And that's all for today's video, folks, but we want to hear from you now. Do you personally use a DCA strategy, or are you more inclined to do so after watching this video? Let us know your thoughts in the comments below. Thank you all so much for watching, and we will see you next time. This is Guy, signing off.